The stock market sounds exciting until people start throwing around words like PE ratio, dividends, and Fibonacci retracement. Confused? You're not alone. In this video, I'm breaking down all the key stock market terms in plain English, so you can finally invest with confidence, not confusion. Let's simplify the market together. A stock, or share, is a unit of ownership in a company. When you buy a stock, you're essentially buying a piece of that business. Own one share of Apple, you're now a part owner of Apple. Congratulations. Equity is just another word for ownership. It represents your claim on a company's assets and earnings. So when you hear someone say, I have equity in a business, it means they own a portion of it, usually through shares. A stock exchange is the marketplace where stocks are bought and sold. Think of it like Amazon, but instead of buying products, you're buying companies. The most famous ones, the New York Stock Exchange and NASDAQ. A ticker symbol is a short code that represents a company on the stock exchange. It's how you quickly identify a stock. For example, Apple is AAPL, Tesla is TSLA, and Google is GOOGL. A portfolio is just your collection of investments. If you own Apple, Microsoft, and an index fund, all of those combined make up your portfolio. It's like your personal investment menu. An investor is anyone who puts money into assets like stocks, real estate, or businesses with the goal of growing their wealth. Long-term investors usually buy and hold stocks for years, not minutes. A broker or brokerage is the middleman that helps you buy and sell stocks. These can be actual people, or more commonly now, platforms like Robinhood, E-Trade, or Fidelity. A commission is the fee a broker charges to place a trade. Many platforms now offer zero commission trading, but some still charge for certain types of orders or services. A public company is one that sells its shares to the public on the stock market. These companies must follow strict rules and report their earnings regularly. Apple, Amazon, Coca-Cola, all public companies. A private company isn't listed on the stock exchange. Its shares are not available to the public, and it's usually owned by a small group of people or investors. Think of companies like SpaceX or IKEA, both private. A dividend is a portion of a company's profit that gets paid out to shareholders. Not all companies pay them, but many do, especially big, stable ones. For example, if you own stock in Coca-Cola, you might receive a small cash payment every quarter just for holding the stock. Unfortunately, it works the other way too. A capital loss happens when you sell a stock for less than what you paid. Bought at $100, sold at $80, that's a $20 loss. It's part of investing, and even the pros take losses sometimes. Yield refers to the income you earn from your investment, usually expressed as a percentage. If a stock pays $5 a year in dividends and costs $100, its yield is 5%. High-yield investments might pay more, but often come with higher risk. ROI, or return on investment, tells you how much profit you made compared to what you invested. Say you invest $1,000 and earn $200. Your ROI is 20%. It helps you compare different opportunities to see which one's actually worth it. Compound interest is when you earn interest on your interest. Let's say you invest $1,000 and it earns 10%. Next year, you're earning 10% not just on the original $1,000, but on $1,100. Over time, this snowballs, and it's how the wealthy really grow their money. Risk tolerance is about how much risk you're personally comfortable with. Some people are okay watching their portfolio drop 20% if there's a chance for big returns. Others prefer slow, steady growth. Knowing your risk tolerance helps you invest smarter and sleep better. A market order is the most straightforward. It tells your broker, just buy or sell this stock right now at the best available price. It's fast and simple, but the exact price you get can vary, especially if the market is moving quickly. A limit order, on the other hand, gives you more control. You set the price you're willing to pay, or the price you want to sell at, and the order only goes through if the market hits that number. So if Apple is trading at $190 and you set a buy limit at $185, your order waits until it drops to that price. A stop order, often called a stop loss, is designed to protect you from big losses. You set a trigger price. If the stock falls to that level, it automatically sells. For example, if you own a stock at $50 and place a stop at $45, the trade kicks in once it hits that point to limit your losses. A trailing stop order is like a smarter version of a stop loss. Instead of using a fixed price, it follows the stock as it rises. So if your stock climbs from $100 to $110, your trailing stop might stay $5 behind and adjust upward as the price goes up. If the stock drops suddenly, it sells to lock lock in profits. A fill or kill order, or FOK, is exactly what it sounds like. It must be filled immediately and entirely, or it's canceled. No partial fills, no waiting. This is mostly used by institutional traders making large moves and needing full execution instantly. A good till canceled order, or GTC, stays active until it's either filled or you cancel it. This is useful if you have a target price in mind, but don't want to watch the market constantly. Just set it and let it ride. It can stay open for days or even weeks. A day order is the opposite. It only lasts for the current trading day. If your price target isn't met by the market's close, the order expires automatically. Now here's a term you'll hear a lot if you're exploring short selling: buy to cover. This is how you close out a short position. When you short a stock, you're betting its price will drop, so you eventually have to buy it back to return it. That buyback is called buying to cover. And speaking of short selling, here's how that works. Shorting is when you sell shares you don't own, hoping the price drops so you can buy them back cheaper. For example, if you short a stock at $100 and it falls to $80, you buy it back at the lower price and keep the $20 difference. It's risky, because if the stock goes up instead, your losses are potentially unlimited. Common stock is the most well-known type. When people say they own stock in a company, they're usually talking about common stock. It gives you ownership in the company and often includes voting rights, like voting on company decisions or board members. You also get a piece of the profits, if any are paid out. Preferred stock is a little different. You usually don't get voting rights, but you do get something else: fixed dividends. And if the company goes bankrupt, preferred shareholders get paid before common shareholders. It's kind of a blend between a stock and a bond. A blue chip stock refers to shares of large, stable, and financially solid companies. Think Apple, Microsoft, Coca-Cola. These companies are industry leaders, and while they may not double overnight, they tend to weather storms and grow steadily over time. Growth stocks are all about potential. These are companies expected to grow much faster than average, often in tech or innovation-driven sectors. They typically reinvest profits back into the business instead of paying dividends. Amazon and Tesla were classic growth stocks in their early days. Value stocks are companies that are undervalued by the market. In other words, the stock price is lower than what the company is truly worth. These stocks are like finding a high-quality item on clearance. You're buying value for less. Dividend stocks are exactly what they sound like: stocks that pay out regular income to shareholders, usually every quarter. These are great for investors who want steady cash flow, especially in retirement. Utility companies and big consumer brands are common dividend payers. A cyclical stock rises and falls with the economy. When times are good, these companies thrive. Think airlines, hotels, or car manufacturers. But when the economy slows down, these stocks usually take a hit too. Defensive stocks, on the other hand, are the opposite. These are companies people rely on no matter what's happening in the economy, like healthcare, food, or utilities. They tend to be more stable during recessions or downturns. Penny stocks are low-price stocks, usually trading for less than $5. They often come from smaller, less established companies and carry a lot of risk, but also big potential rewards. Just be cautious. These stocks are highly volatile and not always well regulated. Lastly, speculative stocks are based more on future potential than current performance. These might be startup tech companies, biotech firms with one big drug in development, or any business betting on a major breakthrough. The upside is huge, but so is the uncertainty. A bull market is when prices are rising and investor confidence is high. It usually reflects strong economic growth and optimism. Think of a bull charging upward. That's how the market is moving. A bear market is the opposite. Prices are falling and there's widespread pessimism. Typically, a bear market is defined by a drop of 20% or more from recent highs. It's called a bear because bears swipe downward, just like prices in this market. A correction is a more moderate drop, usually about 10% or more from a recent high. Corrections are common and often healthy for the market, helping to cool down overinflated prices. A crash is a sudden and severe drop in the market, often triggered by panic selling, economic shocks, or unexpected events. Crashes are sharp, fast, and can wipe out years of gains in days. Volatility refers to how much a stock's price moves. High volatility means big swings, up or down, while low volatility means the price stays relatively stable. Tech stocks tend to be more volatile, utility stocks less so. Liquidity is how quickly and easily an asset can be bought or sold without affecting its price too much. Stocks of big companies like Apple are highly liquid. You can buy or sell them instantly, but smaller, lesser-known stocks may not have that same ease. Volume is the number of shares traded in a given period. High volume usually means lots of investor interest, and it can confirm the strength of a price move. Low volume might suggest uncertainty or lack of attention. Market cap, or market capitalization, is the total value of a company based on its stock price and number of outstanding shares. It's calculated by multiplying the share price by the total number of shares. It tells you how big a company is: large cap, mid cap, or small cap. EPS, or earnings per share, shows how much profit a company makes for each share of stock. It's a key measure of profitability and is used in many other financial ratios. The PE ratio, or price to earnings ratio, compares a company's stock price to its earnings per share. A high PE might mean the stock is overvalued, or that investors expect strong future growth. A low PE could mean it's undervalued or facing challenges. The PEG ratio builds on the PE by factoring in expected growth. It's the PE ratio divided by the company's earnings growth rate. A PEG under 1 might signal a good value, meaning the stock is cheap relative to its growth. Book value is what a company would be worth if all its assets were sold and debts paid. It's a conservative measure of a company's net worth, and some investors use it to find undervalued stocks. Intrinsic value is what a stock is truly worth based on analysis, not just the market price. Investors calculate this using factors like cash flow, assets, earnings, and growth potential. If the intrinsic value is higher than the current price, the stock may be a good deal. Dividend yield tells you how much a company pays out in dividends relative to its stock price. For example, if a stock pays $4 in annual dividends and is priced at $100, the yield is 4%. It's a favorite metric for income-focused investors. Beta measures how volatile a stock is compared to the overall market. A beta of 1 means it moves in line with the market. Over 1, it's more volatile. Under 1, less risky. It helps investors understand how a stock might behave in different market conditions. If you've made it this far and you're learning something new, take a second to hit that like button. It really helps the channel reach more people who want to understand the market just like you. Revenue is the total income a company brings in from selling its products or services. It's the top line on the income statement, before any expenses are taken out. Think of it as the raw fuel powering the business. Net income is what's left after all the bills are paid. You take the revenue, subtract all expenses, including taxes, salaries, rent, and interest, and what remains is the net income. This is often referred to as the bottom line because it shows a company's true profitability. Operating margin measures how much profit a company makes from its core business operations as a percentage of its revenue. It excludes things like taxes and interest. A high operating margin means the company runs efficiently and controls its core costs well. Profit margin is a broader view of profitability. It shows what percentage of revenue ends up as net income after all expenses. If a company has a profit margin of 20%, that means it keeps 20 cents for every dollar it brings in. The debt-to-equity ratio shows how much a company relies on borrowed money versus what shareholders have invested. A high ratio could mean the company is over-leveraged and at risk if things go south. A low ratio suggests it's operating more conservatively. Return on equity, or ROE, tells you how effectively a company is using shareholders' money to generate profits. It's calculated by dividing net income by shareholder equity. A high ROE means the company is turning investor capital into profits efficiently, a key sign of strong management. An ETF, or exchange-traded fund, is like a bundle of different assets, stocks, bonds, or commodities, all packed into one investment that you can trade just like a stock. It gives you instant diversification, often with lower fees than other funds. A mutual fund is another type of investment basket, but it's professionally managed. Investors pool their money together, and a fund manager decides what to buy and sell. Unlike ETFs, mutual funds don't trade throughout the day. They're priced once at market close. An index fund is a type of mutual fund or ETF that simply tracks a specific market index, like the S&P 500. Instead of trying to beat the market, it mirrors it. Index funds are popular for their low fees and consistent performance over time. A REIT, or real estate investment trust, lets you invest in real estate without actually buying property. These companies own and operate income-generating real estate, like malls, apartments, or office buildings, and they pay out most of their profits to shareholders as dividends. A hedge fund is an aggressively managed private fund that uses advanced strategies, like short selling, leverage, or derivatives, to try to earn high returns. They're usually only open to wealthy investors due to their high risk and complex nature. Options are contracts that give you the right, but not the obligation, to buy or sell a stock at a specific price before a certain date. They're used to speculate on price moves or hedge against losses. Options can be powerful, but also risky if you don't fully understand them. Futures are similar to options, but they're binding contracts to buy or sell an asset at a set price on a future date. They're used heavily in commodities, like oil or wheat, and by traders looking to lock in prices. Unlike options, futures must be executed, win or lose. A bond is basically a loan, but you're the lender. When you buy a bond, you're lending money to a company or government. In return, they pay you interest over time and return the full amount when the bond matures. Bonds are considered more stable than stocks, and they're often used to balance out risk in a portfolio. The S&P 500 is one of the most well-known market indices. It tracks the performance of 500 of the largest publicly traded companies in the US, across many sectors, like tech, healthcare, energy, and more. It's often used as a benchmark for the overall health of the US stock market. The Dow Jones Industrial Average, or DJIA, is another major index, but it only includes 30 large, established US companies. These are industry giants like Apple, Boeing, and Coca-Cola. While it represents fewer companies, it's still considered a powerful snapshot of the American economy. The NASDAQ composite tracks over 3,000 companies listed on the NASDAQ exchange, and it's heavily weighted toward tech. This is where you'll find names like Apple, Amazon, Google, and Tesla. If you want to get a sense of how the tech sector is doing, the NASDAQ is the one to watch. The Russell 2000 is an index of 2,000 small-cap US companies. These are smaller, often up-and-coming businesses. Investors look at the Russell 2000 to understand how the small business segment of the market is performing. It's a good pulse check on domestic growth and innovation. The VIX, also known as the Fear Index, measures market volatility. When the VIX is high, it means investors are nervous and markets are expected to be more volatile. When it's low, it usually signals calm, stable conditions. It's not about direction, up or down, but about how wildly prices are expected to move. A day trader is someone who buys and sells stocks or other assets within the same trading day. They're looking to take advantage of small price movements and usually make many trades throughout the day. It's fast-paced, risky, and requires close attention to the market. A swing trader takes a slightly longer view. They hold positions for several days or even weeks, trying to catch short to medium-term price moves. It's less intense than day trading, but still active and often based on technical analysis. A position trader holds their investments even longer, from weeks to several months. They're not worried about daily ups and downs. Instead, they focus on broader market trends and major developments that take time to play out. A long-term investor takes a buy and hold approach. They invest in companies they believe will grow steadily over many years. This is the strategy used by legends like Warren Buffett, focused on long-term value, not quick wins. A value investor looks for stocks that are priced lower than they should be. These investors hunt for bargains, companies that are temporarily out of favor, underpriced based on fundamentals, or misunderstood by the market. A growth investor focuses on companies with high potential to grow earnings and revenue quickly. These stocks may not be cheap now, but the bet is they'll be worth much more in the future. Think early-stage tech companies or innovators disrupting industries. A dividend investor looks for companies that pay out consistent dividends, usually big, stable firms. This strategy is often used by people who want regular income from their investments, like retirees or income-focused investors. An index investor keeps it simple by investing in entire market indices like the S&P 500. Instead of trying to pick individual winners, they buy a slice of everything and ride the overall market's long-term growth. It's low-cost, diversified, and ideal for passive investing. A contrarian investor goes against the crowd. They buy when others are panicking and sell when everyone's excited. The idea is that the market overreacts, and going the opposite direction can lead to big gains if timed right. A momentum trader does the opposite of waiting. They buy stocks that are already rising quickly and hope the trend continues. They're looking for strong price action, often driven by news, hype, or investor excitement, and try to ride the wave before it crashes. FOMO, or fear of missing out, is one of the most common emotional traps in investing. It happens when people buy into a stock just because it's trending or skyrocketing, not because they've done any research. This kind of emotional decision-making can lead to buying at the top and losing money when the hype fades. A pump and dump is a market manipulation scheme, usually involving low-priced stocks. Here's how it works. Someone hypes up a stock with false or exaggerated claims to pump up the price. Once it spikes, they sell, or dump, their shares for a profit, leaving other investors stuck with the losses. Always be cautious of unsolicited tips or sudden hype online. A stock is considered overbought when its price has risen too far, too fast, often beyond what its actual fundamentals justify. It doesn't always mean a crash is coming, but it can signal a short-term pullback. Traders use this as a warning sign to be cautious. On the flip side, oversold means a stock has dropped significantly in a short period, sometimes because of fear, bad news, or overall market panic. It can signal a potential buying opportunity if the company's fundamentals are still strong. A market bubble happens when prices rise way above the actual value of stocks or assets, often fueled by hype, speculation, and unrealistic expectations. Eventually, bubbles pop, and when they do, prices come crashing down fast. Famous examples include the dot-com bubble and the 2008 housing bubble. A correction is a natural part of market cycles. It refers to a temporary pullback, usually around 10%, after prices have gone up too quickly. Corrections help cool off the market, shake out weak hands, and reset prices to more reasonable levels. They're not crashes. They're more like taking a breath before the next move. Technical analysis is all about reading charts and patterns to try to predict where a stock's price is headed. Instead of focusing on a company's financials, technical traders look at things like volume, trends, and price movement to find entry and exit points. Fundamental analysis, on the other hand, is the study of a company's actual business, things like revenue, profit, debt, and growth potential. It's about figuring out what a company is truly worth and whether the stock is undervalued or overvalued based on real data. A moving average is one of the most commonly used tools in technical analysis. It smooths out price data by showing the average stock price over a certain period, like 50 days or 200 days. It helps traders see the overall trend and filter out short-term noise. MACD, or moving average convergence divergence, is a momentum indicator. It shows the relationship between two moving averages and helps traders spot changes in a stock's direction, whether it's gaining or losing strength. RSI, or relative strength index, measures how overbought or oversold a stock is on a scale from 0 to 100. An RSI above 70 usually means a stock might be overbought. Below 30, it might be oversold. It's a quick way to spot when a stock might be due for a pullback or a bounce. Fibonacci retracement is a chart tool used to identify potential support and resistance levels based on ratios derived from the Fibonacci sequence. Traders use it to figure out where a stock might pause or reverse after a big move up or down. Support and resistance are price levels where a stock tends to bounce, support, or struggle to rise above, resistance. Support is like a floor, resistance is like a ceiling. These levels are key in technical trading. A breakout happens when a stock moves above resistance or below support, often with high volume. This can signal the start of a new trend, and traders often look for breakouts as a sign to buy or sell. A candlestick chart is a popular chart style that shows the high, low, open, and close prices for a given period. Each candle tells a story about price movement and investor sentiment, and traders use patterns in these candles to make predictions. A margin account lets you borrow money from your broker to buy more stocks than you could with just your own cash. It increases your buying power, but also your risk. If the market moves against you, losses can add up quickly. Leverage is when you use borrowed money to increase the size of your investment. It can magnify your gains and your losses. It's a powerful tool, but it should be used with caution and a clear strategy. Alpha measures how well your investment performed compared to the market. If you beat the market, you've generated positive alpha. It's a way to measure skill, or luck, in active investing. The Sharpe ratio helps investors understand how much return they're getting for the amount of risk they're taking. A higher Sharpe ratio means better risk-adjusted performance. It's not just about gains, but how safely those gains were earned. And finally, diversification is the golden rule of risk management. It means spreading your investments across different assets, like stocks, bonds, real estate, or sectors, so you're not overly exposed to any one thing. If one investment drops, the others might help balance it out. Now you've got the language of the stock market down, and that's a big first step toward becoming a smarter investor. If you found this helpful, don't forget to hit that like button, subscribe for more simplified finance content, and drop a comment if there's a term you'd like me to dive deeper into. Thanks for watching, and I'll see you in the next one.